In this video, I'm going to answer a question that was put to me online by someone who was concerned about the security of their investments, their ISAs, if they have it all on one platform. So I shall read the question out in full. All of my investments, stocks and shares ISAs, are currently with one platform provider. I've been thinking about the consequence of that provider failing as a business. Would it be advisable, therefore, to have my investments on two or more platforms to reduce the risk? Now, it's a common question, an absolutely understandable one. When we were young, we were being told by our parents or grandparents that we shouldn't have all of our eggs in one basket. And to an extent, with our money, that's absolutely wise counsel. When we're investing, we want to diversify as much as possible around the world and in different asset classes, because that way we don't get burnt by a single small holding or large holding in one company going bust. So the more we spread it, the more we reduce that individual risk. But where we have our money on a platform or with a pension or an ISA provider, if we spread it around too much, we may lose the benefit of certain cost reductions for larger size funds. It can also be a bit harder to keep track of what you have, so you don't get financial clarity. And also it's just a bit harder to administer. We've got all the pots of money around different places, we get different statements in. So there are definite advantages and reasons why we might have them all in one place. And since the days of Equitable Life and the banking crisis of 2008 and 2009, the level of cover, security that we have when we invest our money with large financial institutions has improved considerably, and there's a number of different levels of protection. As an absolute final resort, we can call on the Financial Services Compensation Scheme, the FSCS, and that will cover our investments up to a limit, and these limits are subject to change. So look in the notes section here for a link to the FSCS website to find out what the current limits are. However, they are often lower than we might have managed. So if we're calling on the FSCS, we might find we don't get all of our investment back again. But I have said it's an absolute last resort, and there are a number of layers of protection above that, having to call on the FSCS. And the first one, the main one, is that any financial institution that wants to operate in the UK has to demonstrate ongoing capital adequacy to the regulators. And for financial institutions in the UK, the regulators are the Financial Conduct Authority and the Prudential Regulatory Authority. And if they can't demonstrate their financial strength, financial resilience, then they can't operate. And it's a high bar they have to pass. So they should be able to withstand major financial shocks. So that's the first level. Then it's a regulatory requirement that any financial institution separates their own assets from the assets of their investors. So should a company fail or should it be mismanaged, it's not possible for them to go into invested pots to bail out the operations, and their large third-party depositories, financial institutions that manage billions around the world, who act as the oversight, if you like, they ring fence that money, so they can't just go and take it from investors willy-nilly. So that's another strong indication of the security of your money these days. And then when you invest the money at a high level, you'll have chosen a platform for your share ISA in this case, or it could be your pension or your investment account. But then you'll have chosen individual funds in which to invest, fund managers in which to invest, and they themselves have to demonstrate capital adequacy to operate in the UK, and they have to keep their investor money separate from their own operations. If you've chosen a investment manager that operates outside of the UK in Europe, which is often the case, even though you're a UK-based investor, you need to make sure that they have a degree of regulation. And in Europe, in the European Economic Area, they will be what's known as UCITS compliant or regulated, or they have a SICAV, SICAV trading style. and if they've got those, then they've also got a very high bar of regulatory compliance that they need to cover. If it's not a UCITS or a CCAR fund, you need to be a bit wary, because you might not have that regulatory oversight or the ability to get any money back should a company fail. And one big warning sign is if an investment is what's called a UCIS. So slightly confusing. We've got UCITS and UCIS, but UCIS is unregulated collective investment scheme, and these are some of the exotic ones that you might see, investing in Dubai car parks or Amazonian rainforests and teak farms and things like that. That's where you need to think about the old adage of, if it sounds too good to be true, it probably is. If you're looking at a financial promotion that's offering high returns for no risk, walk away from it quickly, because your money won't be protected. So the next layer, and the main area where we spread our risk, is within the individual funds, and I said at the start of the video, around the world in different asset classes. Because our main risks we face as investors is the stock market risk, the daily, weekly, annual fluctuations of the stock markets. And if we're taking we have too much exposure to a single company, a single fund manager, a single fund, and that goes south, then our money is at a risk, and you wouldn't be able to call on the compensation scheme if it's just investment losses. But the final point to make is that the biggest risk we face as investors is our own personal behaviour, and that might be with choosing inappropriate investments, but more often than not, it's just we react emotionally to our investments. We might see that the value of our investments fallen dramatically due to stock market conditions, and these stock market conditions are cyclical. We know stock markets go down in the short term, but over the long term they have an upward trend. But too often investors get burned because they see them fall, they panic, and they sell their assets, they sell their holdings, and then they've crystallized a loss, so they're not there for the recovery. The cryptocurrencies is a great example of this. People have seen the really sky high values and wanted a part of it, and so have been greedy, and then they've fallen dramatically over the past month or so, or whatever the time period has been, and they think it's no longer appropriate investment, so they cut their losses and they're out, and they've definitely lost. So to conclude, it's not necessarily inappropriate to have all your money on one platform. There are advantages to doing so, and these days there are a number of layers of protection should the platform fail, but the chance of that happening these days is much lower than it used to be. So I hope that helps answer the question.